Hi, I'm Tony Batista. Before we started 20 years, I was a market maker on the floor of the CBOE, that's the Chicago Board Options Exchange, and the Chicago Board of Trade. But today, we're here to help you learn about strategies, entry and exit. My goal, when I'm done with this, is that you have a good blueprint for starting a trade, and more importantly, what I think is the most important thing, mechanics to getting out of that trade. Let me give you a little bit of content before we go into those strategies, and there'll be about 6 of them. Allocating 18% of your entire portfolio to short puts gives us the same return. Remember, a short put is a long strategy, long delta strategy. The same return as holding 100% of SPY stock. Now, why is that important? 2 things. One, everybody's measured by the S&P and its return per year. That's the Standard & Poor's 500. Allocating only 18% of your portfolio to naked puts gives you that same return. Now, I'm not saying that's what you should do, but think about it. That gives you what? 82% of your portfolio sitting in cash to do whatever you want with it. Maybe enhance those returns even more, because matching the S&P and taking risk, well, we don't want to do that. We want to have more return, taking just about the same risk. So the strategies, the plan of attack for opening positions, that'll be the first thing I'll talk about. And inside those slides, on one slide, I'll give you the mechanics too, the optimal rules of processing over time. Okay, 6 strategies: short strangle, credit spreads, ratio spreads, Iron Condors, diagonal spreads, and broken wing butterflies. They're all a small part of each other. So we'll tackle one and we'll break them down individually. First one we're going to go to is the strategy, a short strangle. Maybe, probably, and should be, it is my most popular strategy in a high IV rank stock. Now, how can you find the IV rank? On Tastyworks, it's right on top of your platform on the left-hand side inside a circle. Very easy to find. This strategy is a simultaneous sale of an out-of-the-money call and an out-of-the-money put. Now, what call and what put are we looking to sell? We typically go around the 30 delta call and the 30 delta put. Remember, delta is just shares of stock. What it equates out to, what it simulates. It simulates about 30 shares of stock. If I'm selling 30 shares of stock and I'm buying 30 shares of stock, it's basically neutral. We start out these strangles at a neutral position most of the time, unless you have a bias with a long delta or bias with a short delta. It has a high probability of success, 70 to 90% if you're using that 30 delta strike. If you're using a different delta, obviously, it's going to have a different probability of success. The management of this, it's 50% of the credit received. Now let me explain that to you. If we sell the call and the put, and it's a delta neutral strategy, and you bring in $2 for argument's sakes, that's $200. We're looking to close that at a $100 profit. That's 50% of the credit received. That's important to listen to or remember for these next slides, because I'll leverage that 50% of credit received throughout most of this video. 21 days DTE, which means 21 days till expiration. That's really the mechanics of this. When are we looking to get out of this trade? Either we collect 50% of the credit, or there's 21 days left to expiration. What are the defensive, the mechanics? And I think that's more important, because getting into a trade is fairly easy. High IV rank stock, liquidity is always king. And now, how do I get out of it? Because getting in seems to be very easy. Getting out, everybody falls in love with their trade. For me, the rolling on the defense, rolling the untested side. What does that mean? If the stock is going higher, I'm going to roll up puts. If the stock is going lower, I'm going to roll down calls, rolling the untested side. When do we do that? Typically when our strike is breached or our delta gets too big. Roll the position out in time would be the second thing we can do. 21 days to expiration hasn't come up yet. We're going to take that position from the front month to the back month. We may even use the same strikes. That'll give us more credit, more time, higher probability of success, and not use any more buying power. Go inverted. This is something that has developed and come out with. You've got a call and a put. The stock is going too low. Your put is being tested. You take your call below your put. That's inverted. On the opposite side of the spectrum, you've got a call and a put. The stock is going too high. You take your put and go over that call. That's inverted. Now, what does that do? That reduces your delta. We're always looking to reduce our delta by 25 to 50% when we do any type of management or mechanics to this trade. That's the short strangle. Next one that we're looking at here is, why put on these? You want to put these on with high volatility. This is a good graph, a good explanation of what you can expect to receive. The premium collected, if you notice, will go right through the middle where the VIX is most of the time, that 20 to 30 range. The premium collected is 1.3% of the money used. That's pretty cool when you look at 0 to 10% VIX and even greater when it's above 40 on VIX. That's VIX. That's the volatility index. So when volatility is high, which only around 4% of the time, you collect more premium. When volatility is low, you collect less premium. We want to collect more premium. So what are you going to look to do? You're going to look to ramp up your trades when volatility is higher. Somewhere between that 10 to 30% range, optimally somewhere around 20, 25%, which is where we land just about 70% of the time in volatility. Strangles make a great strategy. The short strangle, on average, when IV rank is below 30, we tend to see IV move against us. What's IV? That's implied volatility. It moves against us. Let's take a look at what that means. It's just showing you that over time, volatility contracts faster than it actually goes up. Now, it moves swifter on the way up, but once it's there, it continually contracts for a longer period of time. What do we want when we put on a trade? We want high IV rank, we want the stock to have a high implied volatility, and then slowly contract, because as it contracts, we make money on our theta decay. Also in the short strangle, what strikes are we looking to? I explained it to you from the beginning. It's the 30 delta. The 30 delta gives us, it gives us less chance of a whipsaw. Look at this. If you were to use the 40 delta strangle, you've got almost a 40% chance of a whipsaw. What do I mean by a whipsaw? That just means that the stock keeps going back and forth between one or both of your strikes, meaning it goes above your call and goes below your put, which you don't want it to do. Now, in the 30 delta strangle, only happens 8% of the time. Now, of course, you're collecting less premium, but you know what? For that 30% difference in being whipsawed, which is what most customers, most retail investors like myself don't want to happen, I think it's a good takeaway. Second strategy is an Iron Condor. It's just combining that short call and put that we did and then defining our risk by buying a call or a put, a call above and a put below our two short strikes. The strategy has about the same probability of success, but I want to caution you here, it's a lot less money. Even though it's the same probability of success, a lot less money to make, but you're using a lot less buying power, you have a lot less risk. Management of this trade is exactly the same of the strangle as the strangle. The defense, the mechanics, there really aren't too many. Let me explain. A tight Iron Condor, say $5 wide between the difference of your short call and your short put, if it's like $5 wide, there's not too much to do. You have limited risk. You collected 1/3 the width of the strikes. So let me explain. If it's a $3 wide Iron Condor, you'd collect $1, meaning I only can make $1, I can lose $2. That gives me a little over a 70% probability of success. If I'm collecting more money, I have a lower probability of success. So on a $5 wide Iron Condor, we'd want to collect somewhere between $1.60 and $1.70 to keep our probability of success the same. And you want to know something? There's not too much you can do with that because you're only using $200-300 worth of buying power as opposed to $2,000 or $3,000 in the strangle. Limited risk, collect enough premium, that premium's 1/3 the width of the strikes. My next strategy. And as you can tell as we go through these slides, the first slide that I did, the first strategy I did to strangle, kind of gave you a lot more of the mechanics than the rest of these I will do, because they all piggyback on each other. All right, a credit spread. Short call spread, that means you're bearish. Short put spread, that means you're bullish. It's a really popular way of getting some directional risk. Now, please remember, you're going to be right 50% of the time with direction. But if you use the same type of mechanics that we did on the strangle, your short delta is somewhere around the 30 delta call, somewhere around the 30 delta put. Remember, if you're bearish, you'll do a call spread. If you're bullish, you'll do a put spread. You can have about a 60 or 70% probability of success. 50% of the credit received, exactly the same as the strangle. I won't go over it again for you. There's really no defense to this, just like the Iron Condor, and it has limited risk. Limited risk, You can make one, you risk two, about a 70% probability of success. That's what we want. If you're risking one to make one, meaning on a $3 wide credit spread, you've collected $1.50, you have a 50-50 shot. So collect less, have a higher probability of success. Perfect math model. Next strategy is a ratio spread. It's become very popular for me to do ratio spreads in this market that we presently have. What do I mean by that? Volatility is not really low and it's not really high. What does it do? What's a ratio spread? It's a short call and a long call spread put together. Now look at where we have our long call, close to where the stock is. Look at where we have our two short calls, further out of the money, the same delta. I'll give you the exact delta from our research that we've done to show you on the call and the put, which should be your short strikes. It has a very high probability of success. I told you it was one of the more popular strategies as of late, because you know what? Volatility is not necessarily too low, it's not necessarily too high, so this gives me a good mix, makes my probability of success a little bit higher, but yet still gives me that credit that I want to receive so I have positive theta decay. 80 to 90% probability of success is probably one of the highest probability of success trades I will make. Management of this is 30% of max profit. Now let me explain. If you did a $3 wide ratio spread, that means I bought the 100 call and sold the 103 calls. I sold 2 of the 103 calls, I bought 1 of the 100 calls, and I did that for, let's just say, $1 credit. I'd be looking to make 30 cents on that trade? No. Remember, I bought the 100 call, I sold the 103. That's $3 wide. I'd be looking to make 30% of $3 or 1 full dollar credit on that spread. What's the defense of this? Well, you can obviously close the spread. That makes it pretty easy, right? For a profit or a loss. I hope you're not taking a loss. What can we do if we have a loss? You can roll out in time. Roll one of the short options out in time. Let's think about what's happening. You're long a call that was at the money. You're short a call that's further out of the money. Let's just say, for argument's sake, the stock was 100. It goes to 103. You close that call spread, because you have a long call spread, and you take that short 103 call and you move it to the back, meaning you move it to the next month out. Give yourself some time to be right. If you want to make it an even higher probability of success trade, turn it into a strangle. You could sell a put, in my example, cost you no extra buying power to use in your position. All right, so the mechanics of a ratio spread. So since 2005, we've looked at this in a 45-day period because that's when you want to enter a trade. You want to enter a trade throughout all of these strategies around 45 days to expiration. I use the regular monthly options. I use the regular monthly options on all of these strategies because they're the most liquid. Liquidity is king in my book. They move on average of 4.5% and land around the 25 delta strike. Now that's the 25 delta strike on the put and the 30 delta strike on the call. So if I was doing a ratio spread with using puts, my two short puts would be somewhere around the 25 delta, and if I was doing a ratio spread with the calls, my call strike would be my two short calls would be somewhere around the 30 delta call. Next strategy, 5 of 6. We're almost done. Hang in there with me. You got a broken wing butterfly. Remember, I'm trying to put you into progression here. What are we doing with a broken wing butterfly? We're buying one call, selling 2 calls. What does that sound like? The ratio spread that we just talked about. And now I'm buying a call that's further out of the money to define my risk, use less capital. I can do that on the call side. I can do that on the put side. It's really just a combination of a butterfly with a short call spread. Probability of success, I'm sticking around that 70 to 80%. Listen, when I was a market maker on the floor of the CBOE, it was my job to tell you, the retail investor, what price you were going to be filled at, to buy or sell. If I could have had my ways about it, I would have said to the retail investor, you know what, don't go for the 50-50 shot. Give yourself a higher probability of success on entry so you can be successful in the long run, manage those winners, manage those trades to keep the ball rolling. Management of these mechanics over here, we're looking at 25% of the max profit. 25% of the max profit of that strategy. Remember, you've got that embedded call spread. Use the same math that I did on the ratio spread. What's the defense on this? Since you have defined risk, and in most defined risk trades, there really is no defense to it. You can at times move from one month to the next month, but 9 times out of 10 you can't. This is such a high probability of success trade, you have to give it time to work. When do we get out of this? If you remember from my previous slides, when there's about 21 days till expiration. So you're really only in these trades for a few weeks, 2 to 3 weeks. All right, my last strategy is a diagonal. It's a very interesting trade. It's a very complex trade. Listen to me. When I first started in 1983, any trade that used a combination of 1 or 2 options, more than 1 option, 2 options, was called a complex trade. These are not complex trades. What are you doing here? Well, in a diagonal, we're using both front and back month. This is a simultaneous purchase of a long calendar combined with a vertical spread. Let's go to the next slide and see what that means. It's one of the lower probability of success trades. It's also one of the trades that uses the least amount of buying power. Your probability of success is closer to 50 to 60%, so it's not one of my most popular strategies. I saved it for last because it's my least popular strategy just because of the probability of success. What are the management and the mechanics? Very similar to everything else we're looking at. 25 to 50% of the max profit. What can we do for defense? Roll forward to the near month. Yeah, you know what? With diagonals, there's not too much to do in defense either. You're typically setting this trade and letting it work. If it doesn't work, you're taking your defined risk, limited risk. Remember, you don't have unlimited risk on any strategy that I've told you. You can just let it go. The strategy that you have higher risk gives you the leverage, the option to do something about it. Trades that have defined risk, you're a little bit more put into a box, and you have to do your mechanics on the beginning. All right, I really hope you enjoyed this. My name's Tony Batista from I had a blast. I hope you did too.